interesting chat, and we'll play out more of this conversation a little later. But let's move on to our next chat here. Motilal Oswal Alternates, the alternative investment arm of Motilal Oswal Financial Services, the listed companies, closed their first private credit fund. It's called the India Credit Excellence Fund 1. They've raised 1,700 crore rupees. The fund will primarily look to give money in terms of secured lending and customized credit solutions for mid-market businesses in India. Rakshat Kapoor is head and CIO at Private Credit, Motilal Oswal Alternates. Rakshat, good to have you with us here. And,
thanks,
congratulations.
Prashant. Great to have you here.
Huge amount of interest in private credit, as we were just discussing before we hit air. So what should investors? Who are the investors, first of all? I mean, who are the people who've given you money?
So I think pension funds, corporate treasuries, family offices, high net worth individuals. So that sort of comprises most of the supply side of it. I think I would say that the initial years of private credit in India, you would have seen more family offices and high net worth individuals. But as the asset class is maturing, people are running their second, third funds, and more capital is getting returned. So you've seen now, larger institutions coming into some of these funds. And I think
has it been an easier sell and easier raise in that sense? Because I mean, the secondary markets have been struggling for the last year and a half.
So I think, I think from an investor standpoint, they look at consistency in returns, which probably the private credit or the overall fixed income space really sort of gives you. It's sort of less correlation to public markets. And I think, obviously there is a yield pickup over a standard corporate bond. So, I think that sort of also helps in managing and, hedge against the inflation and probably, maintaining an overall returns. And obviously, as long as public markets remain a little bit more volatile, so to that extent, raising money in private side becomes a slightly more easier comparatively.
So for our viewers, you would give money to corporates, right? You would charge them an interest.
So Prashant, this is very simplistically a corporate lending product. So, you lend to corporates, you lend to mid-corporates, and I think...
and then when you receive that interest, you pay that out as dividends to your...
It's exactly a par with how lending to corporates works in very traditional financing shops like maybe banks and NBFCs. Well collateralized, well secured, covenants backed, proper credit conditions, and tightly run and docs, etc.
So here's the question, Rakshat. Why? And this is, we get this all the time. I mean, if you... we covered this as well, a bit of a wobble in the US credit markets, private credit markets, which is, of course, humongous, right? It's grown 10 times in the last 10 years.
Yeah.
Here, of course, we are not picking up. It's pretty large now, and there's a lot of interest, as you said. Who are the corporates who are coming to private credit funds to borrow? Because the general assumption or it's perceived to be that these are lower-rated corporates, right? Who can't access bank credit, because why would you go anywhere else? I'm assuming no one can beat the rates of interest that a bank would charge. So talk to us about that.
No, so I think fundamentally private credit doesn't really compete with bank credit at all. I think it's the nature of risk. I think the traditional banking is more towards day-to-day banking, normal working capital, supply chain, trade finance, and project financing and general capex type of loans. Whereas I think private credit sees an opportunity where there are maybe some dislocations in balance sheets, right? I mean, you sort of expanded capacity, but your revenues are not in line with earnings. So what do? So you probably will have to refinance some of your loans and, to realign your capital structure. And that doesn't fit into your central bank guidelines around where the banks function. So to that extent, you will probably have to step out of banking day to day and go to a credit fund and sort of borrow that interim. Second, I think one of the very important points is that private credit is not like a 10-year money. We are not substituting a long 10-year straight bank capital, right? These are more interim financing solutions. Second is, if you look at, I think a lot of corporates will raise equity for all the current credit cycle that is currently there. And not all sometimes capital comes from equity. So sometimes corporates do try to think, let's try to raise this private credit money, get the catalyst and get the growth triggers in order. And probably after 1 or 2 years, let's go out and raise equity at a better valuation, at a better multiple and things like that. So these are more interim solutions and which is much more bespoke and sort of you try to structure it for corporate. So it doesn't compete with bank credit at all in a way. if you ask me.
How large is the private credit market in India?
Oh, startling. I think it's surging very well. So I think just to give you numbers, I think in calendar year 25, I think the incremental assets were about 12 billion in India, give or take about roughly between 160, 170 transactions. The same number for calendar year 24 would have been incrementally about 9 billion.
Okay.
$9 billion. So I think if you look
this is new credit given
This
out.
is new incremental.
So the total stock would be how much, Rakshat?
I think we're about 35 billion at this point of time. And I think the transactions that you see, I mean, there's a lot of deal activity. There's a lot. And obviously, if you look at, there's a fundamental credit growth in economy, right? I mean, you look at the credit growth on quarter is also 11-12%. Not all capital comes from bank credit and public equities. A lot of traffic does flow towards private credit funds.
Now, the big one, right? The RBI and the regulation, it's unregulated in that sense.
No, of course, look, it's a lending activity, but lending, and we have a regulator, which is SEBI, and I think it's a very tightly governed structures in terms of...
Because the size has become very large. Some seasoned people have said that eventually will the RBI, would it look to...
So Prashant, yeah. I would say that I think depends on institution to institution who's sort of running these funds. And I think more institutionalized frameworks, everybody has a credit policy, everybody has an investing framework. And I think if you follow that governance and framework and disclosures, and I think you follow both in terms of, try to see the best of both the regulators, but it's a very well-governed structure in terms of the approval process with SEBI and even the quote-unquote disclosure that you have to do with your investors and unit holders.
1,700 crores, how many loans would you be making approximately?
So I would say that our first fund is about 3,000 crores. We have announced first close at 1,700. We probably would think about 2022 investments would probably come in this fund.
In the total 3,000 crore?
Yeah. Sometimes also, what happens is it's a 6-year duration. So you do end up recycling some part of your capital. So to that extent, it sort of gets to a little bit higher size and number of deals are higher.
Correct. Rakshat, we'll chat more. Thank you very much. It's an evolving space, as you said. It's a big one in that sense, right? Yeah. Thank you for joining.
Thank you so much, Prashant. Thank you.
All right, we'll take a quick commercial break here. We'll come back and we will focus on Vishal.